Okay, meeting is started. Now we are going to live it stream. Sorry. Please start. Allow.
Good afternoon, everyone. We'll just wait for a couple of minutes and then we'll start. Okay, let's start. Good day, everyone. A warm welcome to our webinar, where we'll unpack the transformative outcomes of the recently held 56th General Council Meeting, which is being dubbed as GST 2.0. Chaired by Honorable Finance Minister, the Council introduced in this meeting sweeping reforms designed to simplify compliance, stimulate economic growth, and ensure fairer tax structure for business and consumers alike. A key highlight is the bold restructuring of GST slabs, streamlining the existing 4-tier system into primarily two rates, 5% for essential and 18% for most of the goods and services, with a new 40% slab for luxury and sin goods. This overhaul, effective from coming Monday, September 22nd, eliminates the 12% and 28% slabs, paving the way for greater efficiency and clarity. These changes aim to reduce the compliance burden and create predictable investor-friendly environment supporting India's ambition to become $5 trillion economy. Beyond structural reforms, the council lowered GST rates on critical sectors like cement and pharmaceuticals. Reduced cement rates will boost infrastructure and housing, while lower pharmaceutical rates will make healthcare more affordable and accessible, fueling demand and economic activity. Clarifications to the place of supply rules for intermediaries and revised tax adjustment guidelines for discount tackle the long-standing ambiguity, promising to cut litigation and simplify compliances for businesses. Institutionally, the Goods and Service Tax Appellate Tribunal is set to begin accepting appeals this month and will start hearing by December 2025, with a deadline of June 30, 2026 for resolving all the backlog appeals. Now, this establishes a time-bound framework for dispute resolution. Additionally, the proposed exemption on individual health insurance and its reinsurance reflect government's commitment to expanding coverage and strengthening healthcare and social security systems. Together, these reforms form a comprehensive package that reduce costs, enhance legal clarity, and fortifies institutional mechanism. In today's webinar, we'll dive into the details of these changes, explore their impact across industries. Our expert panel will provide insights and share their practical experience, followed by an interactive question and answer session. So let us introduce the panel. We first of all have Satyam Rastogi, who is a veteran in tax field and is currently part of a real estate investment group. Then we have Anjana Verma, who is international tax director with ETS Assessment Services and has experience of indirect tax behind her. Last but not the least, we have Ankesh Ajmera, who is heading the indirect tax with the Helion, earlier known as GSK Consumer. He has been instrumental in implementing several tech-enabled tax solutions and contributing to global tax projects. So let's start with our webinar. Welcome, everybody.
Thanks, Ankur.
Thanks, Ankur.
Hi, everyone.
So starting off with Ankesh, representing the manufacturing sector. So given the GST Council's recommendation for rate rationalization, including reductions for certain essential goods and inputs, so what is the industry's take on this and how is the industry reacting to it?
Yeah, thanks, Ankur. I think before starting, just a quick disclaimer. So whatever I'll be saying, it's my personal view, and I'm not representing my company over here. So that's the short disclaimer.
Definitely.
Yeah. n- Now coming on to the industry point of view, I think we all have been waiting for rate rationalization to happen from quite a long time. And therefore, we should be thankful to GST Council for giving us such a big gift with these new rate cuts, and especially for everyday products. And let me tell you, the industry is welcoming this with open arms. It's a huge positive for us in FMCG. You know why? Because it makes things like soaps, toothpaste, biscuits more affordable for everyone, be it big cities, small towns, villages, etc. I think we all are excited about the potential for high consumer demand. More sales, more growth. It's a win-win, right? But, and this is a big but, the devil lies in detail. See, the immediate challenge is a logistical nightmare for us. We have warehouses full of stock with the old MRP. How do we manage this? So, in a way, we are rushing to update everything, be our internal systems, communication with distributors, so on and so forth. The transition is where the real work is. But definitely the long-term benefits are quite clear.
Thank you. So talking about the rate reduction, Satyam, we have also seen cement also going down from 28% to 18%, which directly impacts the construction costs. So should the end consumer be expecting a reduction in the real estate prices?
So I would also like to start with how Ankesh started. that these are my personal views and nothing relates to the company or which I am working with. Uh, so reduction in rates, of course, is a welcome move. But when we talk about the real estate infrastructure industry, then it comprises of commercial as well as residential projects. And primarily, all such projects are large in number and size. So they are generally done by some turnkey EPC contractors, wherein whenever there is a negotiation in prices or the end user, when we talk about end user, the large companies are generally making constructions using the EPC contractors, which generally get the benefit of ITC, and therefore they are charging profit margins on the base cost rather than 28 or 18%, which is the reduced rate. But yes, of course, uh, let's first divide this into two parts. One is commercial, one is residential. When we talk about commercial, since India is globalizing and as the Honorable Prime Minister views also encompass the Viksit Bharat thing. So the globalization is encouraging the multinationals to come to India. And when we say globalization, then we see the similar kind of structures being built up in our country, which are having primarily glass facades and not the temporary, not the buildings which were built earlier. So therefore, if I talk about specifically, as you mentioned, that the rate of cement has reduced. So if I talk about cement, it comprises of around 3 to 4% of the value of the entire project cost, because uh, the primarily the walls are made out of glass and interiors are temporary fit out structures which are made out of good fibers or wood or marbles. So therefore, the rate reduction, we don't see too much significant, but there is certain rate reduction which might happen for small developers or the small projects. Then coming on to residential bit of thing, there are certain developers who are building large housing societies. Again, the same goes hand in hand with the EPC contractors. They get the input credit and the end user. Whenever the cost reaches the end user, it doesn't include the GST component on such items as cement or marbles. But yes, when we talk about small societies, housing societies, the affordable flats wherein the developers do provide certain air conditioners kind of things, split ACs, window ACs, that certainly has to be a beneficial bit as recommended by the Honorable Finance Minister. So therefore, there's a reduction in rate of such components like ACs, washing machines, which they provide along with the furnished accommodation. And therefore, the end user, which are the home buyers, will benefit out of it. And which is the, I think, view which our ministry seeks from, right?
Yeah.
So therefore, I see a good move by the government, and so that the uh, small taxpayers or I should say small citizens, which are middle class citizens, low income groups, they will benefit out of it certainly.
Interesting take. And you mentioned about globalization and the change with respect to intermediary provision. I would say that it's primarily focusing on the traction that we are getting on the GCC front as well. So India is very far. Lot of traction is being received on the lot of GCCs coming up in India. So I think intermediary provisions changes is pertaining to that only. So Anjana, this question to you. So with intermediary gone, so this was the major pain in the service industry. So apart from that, more or less it was things were streamlined. So how do you see it?
Okay, first, hello everyone, and thank you to the SW team for having me here. And of course, the views are entirely personal. On the intermediary, so since the time intermediary was introduced sometime in 2014, at that time, I distinctly remember the service providers. We were, we there was a need to revisit the contracts and assess, how the services would be perceived by the tax authorities, whether they are intermediary, not. And I think the need for that was because of the inherent ambiguity on the definition or the scope of the word or the term intermediary, and of course which led to a wave of litigation that persisted for nearly a decade, from 2014 till a few days back. And I also recall that many well, of course, the agreements were restructured as the tax authorities, they were keen to retain the GST revenue, 18% or 15%, that was the rate then, on what the tax authorities thought were as commission services or intermediary services, which led to numerous contentious cases where even routine marketing services or back office services or consulting arrangements were challenged as intermediary transaction. I remember reading a notable example wherein an Indian consulting firm providing services to clients offices or of its overseas head office was labeled as intermediary activity. And of course, we ended up having a favorable decision. So these interpretation, according to me, they were not aligned with the economic logic. As a growing economy, India should prioritize attracting foreign currency, and yet we ended up imposing a significant tax burden on the service providers who were actively contributing to that goal. Was that fair? According to me, definitely not. Therefore, in my view, this recent amendment, though long overdue, it's critical and a welcome relief. It acknowledges the contribution of service providers, however modest, in bringing foreign exchange into the country. And of course, it promises to resolve one of the most frequently litigated issues in GST, which is an added benefit. And therefore, with the onset of the GCC in last few years, so much emphasis being placed, and India being with offering such a talent pool, um, I I definitely think that this amendment should aid in a positive way to what we desire our India to be. Thank you.
So, Ankesh, coming back to you, in fact, there was this question somebody put in chat as well. Uh, so, with this rate reduction and everything, how how are the companies intending to pass on this benefit to the consumers? I before you answer, let me also elaborate. So, while the rate is being reduced on the main product, but packing, I understand packing material still at 18%, input services still at 18%. So a lot of things still at 18%, but overall input and the output, you can say, has been reduced. So how is the industry planning to actually pass on that benefit to the consumers?
Yeah. So I think I'll answer this question in two parts. First of all, let's talk about how are we passing on these benefits to the consumer, and this is the fun part, right? I mean, see, the entire industry wants to make sure that the consumer feels the benefit of these tax cuts, and honestly, the entire endeavor and the intent is to pass on the benefit to the end consumer. But there can be huge operational hassles, especially for the products which has a fixed price point. Let's say a 2 rupee shampoo sachet, 5 rupees of chips sachet, so on and so forth. So hence, there could be couple of things that you can look at. I mean, in terms of when you see MRP based product, MRP is always inclusive of tax. So a simple math could be that in case if a tax rate is reducing from existing 12% or an 18% to 5%, then of course the MRP should also reduce commensurately. So that is one of the way of passing on the benefit. The second way out could be the more for the same strategy, which means that instead of you lowering the price, especially for these price point packages, you might increase the quantity inside the package. So the same price, but more product. And it's a great way to, offer the value without getting the headache of changing the MRPs. But we need to remember one thing, that government might be watching us out from an anti-profiteering lens. While somebody might say that there is no anti-profiteering law, being there. But I just had a different point of view here, that there is a sunset clause to anti-profiteering investigation being conducted, but the legal mandate under Section 171, subsection 1 still exists. And that legal
Right.
mandate on every taxpayer is to pass on the commensurate benefit of a GST rate reduction. Henceforth, whatever we may do, we might have to look at it from the legal lens of those particular provisions. And of course, the not so good precedents that has happened in past, wherein the companies have been denied the benefit of grammages with few exceptions, so on and so forth. So I think my point of view is that passing on benefit is not just a good business practice. I think it's a legal requirement as well, and industry is more or less committed to do so. And you might have been witnessing a lot of advertisement coming in every day in the newspapers from all lot of companies out there passing on the GST rate cut benefit, so on and so forth. So there's a lot of things going on in and around us in terms of media publicity, advertisement, digital channels, distributor communications, so on and so forth. So I think that is on the first part of your question in terms of passing on the benefits. Now, coming on to the very interesting question that you have raised on the input tax credit and the associated cost structure. And as I said, the devil lies in details. So this is where the real complexity lies, right? I mean, and it's a topic that is keeping us as well as our finance teams up at night. While the GST cuts on goods is a very positive step, no doubt about it. But the picture on the input side is much more complicated. And I'll tell you why. See, we in the FMCG sector spent a huge amount of money on advertisement and promotion, which is, of course, a service. And the service is categorically taxed at a standard 18% tax. Now, when our product's GST rate is coming down to 5%, we are suddenly in an even deeper inverted duty structure. And it gets worse because the law as it stands today, it is not allowing you to claim refund of accumulated ITC on input services like ANP. It only
Definitely.
allows you for goods. So wherever the IDS is on the on account of raw material and packaging material being taxed at a same higher rate, while my output is at a lower rate, I might still go and claim a refund under IDS. Maybe there could be a little timing difference in terms of filing the application and getting the money. But the bigger problem lies on my input services. And this is going to be a massive hit for all the companies out there on their working capital. We are paying substantial amount of 18% on our marketing campaigns, but we can't fully utilize that credit against our outward liability, which will now be taxed at a lower rate. And let's not just forget the capital expenditure. See, any new investment or expansion requires substantial investment in machinery and infrastructure. Now, again, the ITC on this capex is also not included in the refund formula for IDS.
Mm.
So, in case if the companies are making these big long-term investments and a significant chunk of the tax is going to get blocked, it is going to create a serious financial pinch for us. And henceforth, the challenge isn't just about lower rate on our products. It is going to be about the accumulated ITC on our ANP and capex, which is now going to get stuck. And there is no possibility that we see that we may be able to utilize it over the coming few years. And henceforth, this is going to be a real critical issue, which I believe could only be resolved by a policy level solution. So I think we all have to go together in the North Block from for next few years now to represent this issue and get some policy level solution for it.
Definitely. And
So
see, it
that's
is,
our takes.
yeah, and it is not only about the marketing cost. There are a lot of companies who, MNCs here, who are paying royalty or multiple amount to their
Absolutely.
overseas entities. So
Yeah.
even that becomes a blockage.
Yeah. And even a very small example, sorry, just to
Yeah.
add to this further, that even if you see that a lot of companies like us might have been availing the transportation services from the registered transporters who are actually charging us freight on a forward charge basis, not on the
Yeah.
reverse charge.
Mm.
Now, earlier when they were charging us the freight, which was at 12%, now the rate has been increased to 18%.
Right.
So every additional delta in the rate, which was earlier not pinching us because we were all creditable, we could have the opportunity to utilize the credit. Now, every additional amount of tax is going to pinch us badly.
Mm. I think you are right in a way, and I also feel that eventually the cash component that the entities were paying will get reduced. So, and apart from that, the credit accumulation will also increase.
Absolutely.
So, how will so definitely it needs to be at the policy level, and you are right that anti-profiteering is something that most of the companies fear of. So
Yeah. Yeah.
we'll have to work it around. So it's not an easy battle, easier said than done.
Yeah. Yeah. Yeah.
So we talked about Satyam, Ankesh talked about this input tax credit and IDC. Real estate also falls under the same bracket. So from a input service, high input cost, and now with the rates getting reduced as well. So how do you see the large infrastructure projects, whether there would be credit accumulation, or you see that still the credit is manageable to the extent that we are at a comfortable position at a real estate?
Yeah, so I think currently what the current position is that uh, an SSE applies for refunds and they are stuck up for some reason or the other, and therefore what is boils down to is lesser amount available, lesser funds available, and delay in projects essentially. So when we talk about the inverted duty structures, and the government has announced a welcome move that starting late 2025, they will they have formulated a policy wherein the 90% of GST refunds will be granted upfront on a provisional basis. That is a very welcome move for the industry as a whole, and especially when we talk about the small and medium scale enterprises and EPC contractors who generally have some tight margins. They work on sometimes as low as
Yes.
2 to 5% margins. So when we talk about those, they always need funds, liquidity, and therefore at least they will have faster access to funds when you get 90% of refunds outright. So that is a very welcome move, keeping the law aside, and as Ankesh rightly said, that I think services is a primary component which should have been included, but nevertheless, at least this is something that the government has thought of, that whatever refunds they are giving, and and this is causing delays. So at least they have tightened the screws of the officials as well, that please grant 90% of the refund right away, and thereafter you can keep on verifying the documentation, etc., so that the SSEs at least don't have shortage of funds and the working capital, and they can like do away with the borrowing mechanism all the time. And this is a major boost to the MSME sector, EPC contractor. So I see a significant relief for the infrastructure developers here, because it is likely to ease out the cash flow pressures and accelerate the project execution timelines as well. And there will be no delays just because you don't have funds. So, and of course, when you have to arrange lesser funds, it is always a good position for business to prosper.
Definitely. And this will also help in, I would say, with IDS, inverted duty, or any kind of rate reduction whenever it happens, it also leads to litigation. That is an additional cost that the entities bear whenever this happens. So
It all depends,
yeah,
because when you say provisional credit, the government hasn't ever said that documentation will not be verified, or something that the department requires now will not be provided. to them. So I believe the litigation cost could remain the same, but at least the funds would be earlier received than now. So
Yeah.
therefore, if you're talking about a refund process, so there is a litigation cost that is involved in that currently as well, and that is not going to reduce, but at least you will get easier access and quicker access to funds. So that is a helpful and significant improvement in the process, I would say,
Yeah,
irrespective of the litigation cost.
definitely. And talking about litigation, litigation also helps in industry-wide clarification as well. So,
Yeah,
and
correct.
so let's take an example. When we talk about intermediary, there is also a section of industry which are agents who are providing services to foreign universities. So recently, there was a Supreme Court judgment from KC Overseas, which provided that the services provided by these agents to the foreign universities are exports rather than intermediary. And we have this GST legislation changes as well, treating intermediary as exports. So I think more or less the theme is that intermediaries, the taxability of intermediaries has to be cut down. Even courts think so. So Anjana, your take.
Interesting question, Ankur. So, yes, as I previously mentioned, that intermediary was, and hopefully, it brings an end, that it was one of the favorite topic for the tax authorities to pick up, and it always stem litigation. So even for consultant, it was a very favorite issue. So while we have this proposition by the GST Council, I don't think it's a coincidence, because I feel unfortunately that judiciary has always or largely leaned towards a liberal and a business friendly interpretation of the tax
Right.
statutes. So be it direct tax or be it indirect tax. Okay, and of course, this has helped ensuring export classification for genuine cross-border services, avoidance of artificial tax burdens, and recognizing modern service delivery models, wherein the court uh, taken due acknowledgement of the way business is evolving, the processes are evolving, and how we need to come out of the primitive thought and approach. And of course, it helps to ensure the trust of the millions of investors and business units, both domestic and international. I mean, India is international now. And even couple of years back, and of course there has been a lot of litigation on this issue, and including on this agent services. But in case of, I remember Dharmender M. Jani, and it was a Bombay High Court ruling.
Yeah.
They examined whether the intermediary provision, like the constitutionally, was it even valid or not? Because and the issue before them was violation of the principle of equality and the right to trade, and maybe rightly so. That's a different thing that the provision was upheld, but in my view, I think this ruling, and along with others, it highlighted the policy's inconsistencies and the need for a reform that we all wished for. Okay, so I believe that, with the evolving jurisprudence, it paved the way for the recent GST Council recommendations, and it aligned the law with the judicial reasoning and global best practices. I mean, you said, and so as Satyam, the litigation has always been very time consuming when it comes to India. Managing the records, it's cumbersome. Okay, and we never needed it, we never asked for it. Now when I'm in the industry, this is the last thing we want to have on our books, or in our life, in our professional life. So cases like the KC education, these should be dealt with for another reason, with more sensitivity, because that case directly influenced the education needs, and therefore I'm not surprised but really grateful to our judiciary for fostering our trust into the system once again. And I would also, because we're in this topic, and Satyam also mentioned about it, about the refund getting more faster and smoother. That while now, of course, with this amendment, the service providers will be able to treat intermediary as export of services and claim refund. Somewhere, as a taxpayer, I also believe that there is a need for a more for a well-trained and more educated tax authorities at the ground level. While the law provides for something, it stipulates, and the objective and the intent that has been glorified, when by a finance minister, and as in when by the judiciary, there's always been an emphasis on making the system more robust and business friendly. But I don't know where the ease of doing business is. I mean, because when we are dealing with these tax authorities on a daily basis, I really hope and I wish that things improve. So while I welcome all these propositions by the ministry at the central level, but as a taxpayer, as I said, I really hope that things are taken care of at ground level as well. Thank you.
Interesting take. And with this judgment, I'll share an experience. So most of these foreign universities, so a lot of our clients reach out to us whether they can now claim refund for whatever GST they have paid. It's not an easy answer. Had it been a settled position, that 18% GST could have been saved, but now something has gone to government as a tax, claiming that as a refund basis the Supreme Court judgment. So you have to have that fact straight. Each and everything should align with the case facts. A lot of things goes into that. And yes, as an industry, I can understand that getting refunds easier said than done. So,
Sorry, so
you,
just
uh,
one thing to
yeah,
add on this refund, and I think
uh,
these days government is in a practice of introducing provision on the famous terminology as is where is basis.
where is basis? It will remain as its where is. Yeah. So, Anjana, you mentioned about shifting, and when you say about India, and you are handling multiple jurisdictions. So,
Mhm.
what's your take? How is India operating as a GST system or indirect tax system compared to other jurisdictions?
Okay, a very thoughtful question, and so somehow in last few years, uh, I was able to work and experience with multiple geographies when it comes to indirect taxes. And whatever I say, I want to say I'm a proud Indian. Okay, I really love my country. Now we'll come to the tax part.
We all love.
So there are good things and there are bad things. Okay,
Definitely.
or maybe I'll put
Things
it so
for, I
there
would say, rather than bad thing, I would say things that needs
areas of
improvement.
improvement. Yes,
Yeah.
areas of improvement. So yes, I'll correct myself. Um, so on a positive side, I think we have a functioning portal which works most of the days. I'm just keeping the income tax portal issues just few days back. Let's just forget them for some time. But most of the time our portal it's running efficiently, effectively. It's up to date. It has all the notifications, circulars. You can really rely upon it. But then there are some countries where, for example, say Mexico. Mexico has a separate portal for return filing and for payment. But for us, I mean, it's just one portal. We don't need to go to multiple portals. Or the fact that we have uniformity. All our states, and again, I think thanks to the BJP government, which implemented the GST in 2017, we have a uniform tax all over the country, all states, all union territories. That's it has simplified our life in many ways. Whereas you think of a country as big as US, all 50 states, different provisions, different portals. A product may be taxable in one state but may be exempt in other, different rates. they all operate in silos. And it's very cumbersome. It's very difficult just to keep a track. It's manually not possible. You end up relying a lot on software and tools and everything, more manpower, of course. Our laws, as I said, are easily accessible, but there are, like as I give an example of USA, there are many other countries wherein these laws and updates, they are not published in official gazette. And the online access is very limited and not as user friendly as what we have in India. And there are many. So Korea, Vietnam, UAE, various EU countries as well. I mean, I'm not, so it's pan. But at the same time, um, the approach of the tax authorities, where we have a very compliance intensive and very strict penalty regime. But there are countries, for example, say Australia, Saudi Arabia, they're generally very facilitative. There are penalty waivers for occasional delays. There's a 1 day delay, or if you really have a bona fide reason, you write to the authorities, they'll get back, and we have personally experienced remission of interest penalty, uh, which for multinational organization, it's a game changer. Okay, then return filings. GSTR1, GSTR3B, invoice management system, and multiple GST9, 9C, and multiple other reconciliations. But the countries like Singapore, Australia, Vietnam, Chile, the returns are very simple. Okay, simpler structure, much fewer reconciliation. Even in terms of there are countries which give you early payment discount. So if you pay your tax before the due date, you get given some discounts. It's a huge incentive. I mean, I never heard of it before we started dealing with other geographies, but actually countries like USA, KSA, they offer such schemes, and there are frequent amnesty waivers. So, so yes, we are good in some fronts, but as we said, scope for improvement. So there are some areas wherein we feel as a taxpayer, and as I said, India is global. I mean, all the business units, we aspire to be on the top, and I think see we have already made it to top four. When it comes to GDP, and tax is the backbone of the economy. It plays a huge role. And when we really want to attract foreign investment, these simple but critical steps are very crucial in in ensuring that faith of the investors, of the financiers, of the financial institutions, international financial institutions in India. So so yeah, as an Indian citizen, who love our country, I really hope that these steps are taken, and eventually, of course, there's nothing which can be achieved overnight, but eventually there comes a time, and probably in our lifetime, when we see that these things are taken care of, and our tax system is as smooth as we want it to be, and as competitive when we compare it with the global economies. Thank you.
Interesting. So I get your point, Anjana, and yes, there are definitely scope of there are areas where we really need improvement, and so as I mentioned in the starting, so GST at getting operationalized in September 2025. GST was introduced in 2017. It's a good 8 year that we have. Many industries have struggled going to. There was a burden that was unnecessarily increased for high courts or supreme courts had this been operationalized. We have now, while there are notifications that it will be operationalized, and there would be, I seriously hope that the portal is able to retrieve or accept so many applications, because everybody will be in a hurry to file those applications. So, Ankesh, what's your take? What are the challenges you foresee, and does it seem to be June 26, the deadline that the government has set to clear the backlog? Do you see it feasible?
Yeah, so I think while Anjana and Satyam, I was listening, they did mention that we do not want litigation, but I believe we would certainly want a forum where we can, go and litigate. So I
I
think
never said we don't want litigation. I just said that we do receive refunds earlier. Litigation will remain the
yeah,
same.
yeah, yeah. No, no. So jokes apart, but yes, I mean, I think the operationalization of GSTAT, which is Goods and Service Tax Appellate Tribunal, it's a huge relief for all of us, and we have been waiting for years. I think 8 years, as you said. I mean, the ideally the forum which should have been ideally set up within a span of 2 to 3 years has taken a mammoth amount of time, which is 8 long years. And to be very honest, it's not going to be a walk in the park. That the moment, while the official deadline is 30th June 2026, but I'm not sure how it's going to get streamlined because of the tsunami of pending appeals which are lying before either commissioner appeals or high courts, as the case may be. And I think it's going to have its own set of challenges. I mean, as you rightly mentioned, this is a race against time because everybody is going to be in a rushing way of filing appeals before the deadline, and which is going to create a massive bottleneck. I mean, I think taxpayers as well as consultants all would be working around the clock, to compile the documents, file appeals, so on and so forth. I think other important point is that there should not be a slow start. I mean, we would want that GSG stat benches to be fully staffed with both judicial and technical members, because any delay in this process is will means that this backlog is continue to I mean the backlog will continue to pile up, and henceforth defeating the purpose of this tribunal. Another important aspect is that, I mean, while the deadline is there till 30th June, but we should do our every possible step to file this appeal as soon as possible, because the hearing is going to, I mean, the hearing should be granted to the people who are going to file the appeal first. And hence, people should not wait that they are going to utilize this entire time and file the appeal only by the end of the due date. And another important aspect here could be some procedural headaches in terms of how the transition is going to be, especially for the cases which are currently pending before high courts. So, I mean, there could be initial confusion that how these cases would be transferred. I mean, whether you need to withdraw your appeal in the High Court or you need to file a fresh appeal before tribunal. I think some clarity on this aspect should also come in due course. So definitely GSTAT setup is a welcome step, but I think we should all be prepared for a bumpy ride. I think in the initial months, as we all collectively work to clear the accumulated appeals. But I think it's a much needed forum. But yes, the hard work of implementation, I think, is just the beginning.
Yeah, even I feel the first hurdle is to file an appeal, and
Yes.
the system the system should be robust enough to handle so much volume at a given point, because everybody would be rushing to file those appeals
Correct.
because we have a 3 months window primarily.
Yeah.
So let's see how, and I hope that being a consultant, it's always, as you guys said, appeal is necessary.
And being an industry person, we think our appeal should be filed first. So that
Yeah,
adds more
definitely.
pressure to you.
But so I think we can also take up some questions that we have. So Ankesh, this might pertain to you as well. So what happens? So we said that the September 22 deadline. So what happens to the stock that is lying, both at a company and at a stockist level?
Yeah, I think kudos to the government. indeed the kind of clarification that government is bringing uh, with each passing day. Though these clarifications are quite delayed in terms of the kind of implementation that we foresee in our hands, but again, kudos to them. At least the biggest problem of re-stickering all the stock which is lying there with us has been at least solved by the LMA circular, which was recently came. So, of course, the thing that is mandated right now is to do the media publication in terms of making people aware that what is the kind of change in the GST rates, what is the corresponding impact on the prices of our products. And
Product.
I think industry is been doing whatever possible steps that they can take. And you guys have been witnessing the newspapers
Yeah,
in this week, and it's gonna continue till 22nd at least, wherein a lot of companies are coming up with their advertisements in terms of what was the old MRP, what has been the new MRP. There are a lot of communications going around the entire supply chain distribution to make people aware, to make distributors aware that see, this is going to be the rate change. This was the old MRP. This was the new MRP. So I think, yeah, that all things. That's pretty much under our control that we are doing in a way to make our entire ecosystem aware of the changes that are taking place.
yeah, because it becomes difficult for a company like yours or any, for example, for that matter, any FMCG sector who have multiple warehouses across the country. So implementing those changes, because while we are reporting in newspaper, we are publishing everywhere. And the tier 3 and tier 4 cities are the major impacted. I would say these cities where these changes, the even the customer is not aware, the stockist or the sub stockist might not also be aware. So reaching to that last milestone, I think, would be the biggest challenge. So another question that has come in. So Satyam, this is for you on the insurance part. So this industry has been exempted, and what is your take? So whether actually customers will see the benefit coming to them, or you see anything otherwise?
Yeah, good. Thanks. Let me take this up. So I would say this is a very, very welcome move because this includes the individual health insurance premiums, which includes the family floater as well as the senior citizen plans and other life insurance policies. So as a direct result, it gives you a saving of 18% of premiums. Uh, you have enhanced affordability wherein you can increase your coverage or preventive care more to the extent of, if you want to keep the same premium, you can have more coverage in the same amount of premium that you paid in the earlier years. So as an individual, yes, it is a real boost to the individuals. Then from a corporate perspective, they can seek at looking at the individual health programs now rather than taking a corporate group policy. And which will actually result in a wellness focused benefits. Somebody who has certain specific health issue can include that in their individual policy because this is no more a corporate policy. So this will, as a result, this will help in employee satisfaction, more retention strategies, and this is a very, very welcome move by the government. So this might turn into be a game changer for employee welfare. So we can as a corporate offer some cost effective benefits to them. At the same time, as Ankesh rightly mentioned, there is a devil sitting behind. So when you're talking about a company, uh, there are certain illusions which you see as a cost benefit. But when you talk about a medical insurance company wherein the outward supply is at nil rate, they might not be getting the entire inputs against their expenses. For instance, a simple rental expense, they might have to reverse the input or charge it at zero rate. Take it as an entire amount as cost, entire GST value as cost, which will enhance their cost, and accordingly their premiums might be revised to a fairer extent at a higher side. So we are really not sure how this will boil down, but yes, uh, the way it looks optically is, yes, it is a very welcome move, and this should help the individuals in gaining more benefit out of it, whether in terms of keeping the same policy, inclusions, floater policies, etc. But considering the companies might not get the benefit, again, this might increase the premiums, the basic value of the premiums overall. So there might be some difference in the actual premium that was charged prior to October 2025 and post October 2025.
Yeah, even I feel that the cost burden to these companies. So whenever a industry is exempted, the cost burden, including the GST part, it takes a toll. So it gets added to the cost because there is no output liability, the ITC working and everything goes for a toss. So it based on past experience, wherever the industries are being exempted, I really feel that the benefit of that 18% definitely is not something that would be passed on to the consumer. It will definitely be much lower, if at all there would be any benefit out of it. So I think we have one last question. Anjana, you mentioned about global compliances you take care. So India also we have a lot of reconciliations in place, IMS, lot of data reconciliations that happens within the system. So how, does it happen across the globe or India has that unique feature?
So we are the chosen one. So so we are unique, as I said. Too many reconciliation when it comes to India, and on a lighter note, I feel that if you have filed a return in India, you know how to file a return in India. You can file in any country. So so maybe our tax authorities are training us to become global. This is another way. But coming back to the invoice management system, I'm good. I think GST was always compliance intensive. Okay, and with every passing year, as I think the tax bill got used to, and of course with the enhancement of technology, the complexity of our returns, whether monthly or annual, and the associated processes, they've only increased. And if I compare it specifically with the erstwhile indirect tax regime, the current system feels more time consuming and costly, um, because you do not sometimes have an option uh, to manage it on your own. So either you need a dedicated team. So depending upon the size of the business, you need a dedicated team of tax professionals, many times chartered accountants, just to manage the GST compliances, or of course, otherwise you seek support from the consultants. That said, I do believe that the intent behind these measures, including the invoice management system, is to make audits and assessment smoother and more efficient. I mean, rather than waiting for years, because I remember specifically in the previous regime, by the time we would receive a notice for audit, 3 years, 4 years, and some cases 5 years have already elapsed since the time whatever transaction had to happen. It has already occurred. So you, in addition, because of course, there have been some errors, inadvertent errors. So in addition to tax, you end up 18%. So by 5 years, it's almost 90%. So your interest, so tax, interest, and penalty. So you end up paying sometimes maybe 200 to 300% of what you envisage the original liability to be. So that of course is a on a positive side, um, but unfortunately at present I feel this objective of making assessments and audit easier is not accomplished. Maybe we are on our way, but we are still afar. The And this growing complexity, as I mentioned, it has compelled the business units to rely on the consultants, or develop tools software so that these aspects can be managed. But I remain hopeful. If this enhanced invoice level transparency and all this reconciliation mechanism, if these can help the taxpayers like myself build credibility with the tax authorities and thereby reduce audits, scrutiny, litigation, then I feel that the additional burden may be worth it. But I hope this optimism isn't misplaced and that a few years from now, we aren't overwhelmed. And this, of course, this I expect in my lifetime that, I see this, that we are not overwhelmed by the notices and the queries over reconciliation gaps or similar issues, which so far we are receiving. But I hope, these issues are ironed out in the future and we have a more smoother compliance system.
Definitely. Definitely, we
Thank
do
you.
hope that we have the best systems in place, and that brings us into this session. And thank you everyone for joining in. And I hope the session was fruitful, and we are taking away a few what we came as a individual. We are taking few takeaways from these experts. And thank you all three of you for being part of this webinar and look forward. So thank you all.
Thanks,
Thank you,
everyone.
Thank you,
Thanks,
everyone.
everyone.
Thank
Thank
you,
you.
Uncle.
Bye
Thanks a lot.
bye.
Bye.
Bye.